Welcome to Opalesque today. Today I'm in London with Louis Gargour. Louis is the founder and chief investment officer of LNG Capital. Actually, I've known Louis since I think 2004, but obviously you have been around that in hedge funds and alternative investments much longer than that. So please tell me a bit of your history.
A little bit of background. I began my studies in Georgetown University in Washington, D.C. I then went to work on Wall Street and did the famous Salomon Brothers management training program in the 80s. After completing the management training program, I traveled extensively for Salomon Brothers to Europe and was one of the liaisons between the New York and London offices. After Salomon Brothers, I went to do my graduate studies at London Business School. And once I completed LBS, I went to work for JP Morgan and then Goldman Sachs. Both of those jobs involved working in credit, emerging market, and trading and sales. Principally, my background has been European credit, trading and sales. In 2001, after working at Goldman Sachs, I started Europe's first long-short European credit hedge fund. And our objective was to look at techniques that were not used in the markets but were used by the banks, being long and short, having relative value trades, and using the sophisticated techniques we had in the banks for clients' portfolios. That fund was merged with RAB Capital, which was another nascent or small fund in 2001, and we formed RAB Capital. I was head of fixed income, and the rest of the strategies were equity-based. We were able to develop that strategy into $1 billion plus, and we were able to grow RAB Capital into $7 billion under management. After leaving RAB Capital in 2006, I founded LNG Capital. LNG's primary purpose is to bring sophisticated hedge fund techniques, capital preservation, but most importantly to take care of clients, to give transparency, contact with clients, and to be able to articulate what we do. And today we're going to try to talk a little bit about that.
So you founded LNG Capital in 2006. I looked at your materials and your returns, and you have been doing really well. So tell me more about your fund and your strategies.
So a little bit about LNG Capital. We started LNG Capital with one principal fund, a European credit long-short. That was the skill set we brought from RAB Capital as running fixed income portfolios. We now recently have added a long-only strategy, European credit. We've also added a foreign exchange systematic strategy, but the entire strategies under our umbrella all benefit from risk management and oversight by risk committees, very strong operational support, and distribution. So the idea is to offer a number of different strategies to clients, but with consistent quality control, risk management, and operational control. Okay, so the LNG Europa Credit Fund, which is our flagship fund, has been doing extremely well. So far this year it's up about 15%, and it has been in the top quartile of performance during its entire life. We focus on extracting returns by being nimble, dynamic, and responding to market trends. When we need to be defensive, we become defensive using relative value strategies and returning into cash. And when the opportunities present themselves to extract more return from the markets, we tend to look at more idiosyncratic and special situations.
So please tell us more about the opportunities in European credit.
The opportunity set in Europe is one that's driven by different points of the macroeconomic cycle. Post '08, Paulson and other U.S. officials immediately stimulated the U.S. economy by injecting $350 billion into the banking sector, by bailing out Citigroup, Fannie, Freddie, AIG. Our analysis is that Europe was later to achieving the same stimulus. Mario Draghi, not Trichet, his predecessor, did almost exactly the same thing. He injected not 350 billion but 1 trillion euros into the banking system via OMT. More importantly, there's been a bailout of Ireland, Portugal, there's been a partial bailout of Spain, there's been a bailout of Cyprus. In other words, the systemic risk inherent in Europe has been mitigated. But the timing of that mitigation is about 2 years behind the US. So the same factors that were at work in the US about a year or two ago are now at work in Europe. We're seeing corporate deleveraging, we're seeing a benign credit environment, we're seeing low default rates. It's basically a very interesting opportunity in Europe. The peripheral dislocation has created a series of anomalies, i.e. credit in companies that are cheaper than they ought to be because they're located in Italy, Spain, Portugal, Ireland, etc. So there are nascent economic recoveries taking place in Europe. There are different recoveries taking place at different times. So, Spain is maybe behind Ireland. And the companies within those countries are cheap because the countries are cheap. Now, we analyzed a few companies. Telefonica in Spain, global leader in telecommunications. 70% of its sales are done in Latin America. Only 15% are done in Spain, but it trades cheaper because it's in Spain. Fiat in Italy. Fiat has 52% ownership of Chrysler. It's consolidated on its balance sheet. However, Chrysler trades much richer than Fiat because Fiat is perceived to be in Italy. So the opportunities in Europe are now emerging. The ECB is firmly behind, if you will, stimulus, and the rate cycle is very different than that of the US. The US might be tapering and raising rates soon, is actually probably still going to cut rates. So we have a variety of factors that are driving European credit spreads tighter or keeping them where they are now, which gives us great opportunity to make outsized returns.
Tell me more about your portfolio construction process and your overall investment philosophies.
The overall investment philosophy is primarily to preserve capital, is to understand and exploit market directionality, but even more importantly to find idiosyncratic opportunities, i.e. opportunities that are not present simply in the market, but are present in individual securities. So the client comes first, we preserve capital. We always have shorts, we always have hedges. 2, we try to understand what the market is doing. Is it telling us that it's time to put risk on or take risk off? And 3, we look at individual companies and analyze and understand those companies in order to have what we call alpha generation as opposed to pure beta. In terms of our investment process and portfolio construction, we begin unusually from a top-down approach. And when I say top-down, we evaluate macroeconomic factors, what's happening in the world, where are the opportunity sets. We then move in a more granular fashion to looking at whether risk or defensive strategies are merited. We then actually allocate to different sectors. Some of the sector rotations we've had in the past is we've been short autos, we're now neutral automobiles, and eventually we might become positive. We were very defensive on the airlines, and we've now become a little bit more constructive. Banks, a variety of different sectors, telecommunications. So the sectoral approach, a top-down sectoral approach, and the choosing of long, short, and neutral sector allocations and attributions is core to our investment philosophy. The second thing that we do is that we screen. So in other words, if we have determined for the sake of argument that we want to be short an airline, we'll then screen for airlines that do not meet good criteria. In other words, we'll look for airlines that have not hedged fuel prices, that have deteriorating business models, that have older fleets, that have lower margins. And we'll analyze the weak airline and try to identify it via the screening process. The third part of the investment process is to then drill down into the company. We look at the balance sheet, we look at cash flows, we meet management, and interestingly, we pro forma. We look forward and try to understand where the company will be in a year, 2 years, 3 years' time. And we begin to identify the catalysts that are going to give us short or long performance in that particular company.
Please tell us more about risk management and your overall operations at LNG Capital.
I've learned a few things about running money in the past. The most important is that you need a robust operation and you need predefined risk parameters and risk management. In terms of operational support, we have a front-to-back system. We have a granular approach towards looking at cash flows and we have excellent settlement and operations. We also have a corporate institutional sponsor that monitors all our positions on real time, a second set of eyes. So in other words, in position and operational granularity, we know where we are at any one time, and we look at the settlement process and the trading process in a very granular and precise approach to make sure that there are no problems. In terms of risk management, we adopt an approach that's called the universal risk model. And what the universal risk model does is it breaks down risk into the buckets that are most likely to be able to be measured and to be able to be hedgeable. So the four risks as we see it in any portfolio in ours are currency risk, which we hedge out 100% of, duration risk, what I would call idiosyncratic risk, volatility risk, and finally equity risk, i.e. the risk that the portfolio is dragged along with the markets, the beta or the delta adjusted risk in the portfolio. In bond land, different ratings for different bonds mean that those bonds have different risks, i.e. a AAA bond will have less risk than a single A and less risk, so forth, than a triple B. What we do is we look at the constituents of our portfolio in real time and understand the equity or the delta adjusted risk of each of those positions. So when we compose our portfolio, we understand not just the nominal exposure we have, but we understand what I would call the equity sensitivity of the portfolio, the delta adjusted. We also then have a stress test that we run every day on the portfolio saying, what if? There are three types of stress tests. One is value at risk, which is a commonly used tool. The second is CVAR, contingent value at risk. But by far the most important are what if scenario stress tests. We stressed LTCM, Lehman Brothers, flash crash, 07, 08. So we look at a variety of scenarios and see how the portfolios would react in those scenarios. And we're very cognizant of what the expected losses are and where those losses are. So in a real-time fashion, we monitor not only position granularity and VAR, but expected losses in real stress tests and understand and adapt the portfolio. One of our key strengths and attributes is that we're very nimble and very quick to react to market directionality. So from October to September, we may have switched the portfolio around by 15 or 20% in order to adapt to evolving market conditions.
So tell us more about the size of the markets, of the European credit markets, the liquidity, and also what you think is the capacity of your own strategy.
Liquidity in credit markets is one of the most important barometers and things that we monitor. One of the key attributes of what we do is maintain a very liquid, very saleable portfolio. We strive to have the ability to sell 75% of the portfolio in 1 week and 90% in a month. We monitor the underlying liquidity of all our positions, look at the number of market makers, look at the existence of CDS markets, the depth of the repo market, and use tools such as QMGR and other ways in which we can monitor in real time how many bids, how many offers, and the depth of the market. So that's liquidity. We also look at issuers that are not too small and not too big. In other words, our sweet spot is 250 million to 750 million in terms of issuance size. So we're looking at a sweet spot of issuers that liquid but gives equity-like type of returns. The capacity of this strategy is driven by the number of market makers, by the liquidity of the underlying portfolio, but principally by the size of the market. When we first began running strategies in 2001, the capacity constraint was about 500 to 750 million. Given the evolution of the European credit market, it's now a quarter of the US market's size. The number of dealers and market makers has increased, but more importantly, credit default swaps have arrived, the number of issuers have increased, and the number of issues by any issuer have increased, giving us the ability to hedge, to be long and short different parts of the capital structure. So we believe we can run approximately $1 billion in this strategy with no frictional issues whatsoever.
So what is special about LNG Capital? What sets you apart from the other credit funds?
In terms of what I think is our unique selling proposition or sets us apart, Primarily, in a manager, I think you want experience. I've been looking at European credit markets since their inception in 96, 97. And having worked in the banks and having worked in hedge funds throughout that entire time, we've seen specific situations manifest in 01, 02 where we were positive and the market was negative. We've taken advantage of market exuberance in 03 where we are up over 40%. So experience counts. The second principal, I think, component of a good team is the team. The team members have been working together for 11 years. You know, the joke is many couples don't stay together that long. So we've been together for 11 years, understand each other, there's a defined process, and we work very well together. And the third is we have strong, robust risk management and operational processes in place. You know, this is a world-class business that we're building. We have experience in building businesses. We select top quality service providers, we give transparency to clients, and we understand the building blocks and fundamentals are necessary for businesses that are sustainable in hedge funds.
Tell us more about your investor base.
In terms of our investor base, we have institutional backing from a US multi-billion-dollar institution. We also have a diversified client base, which includes fund of funds, family offices, and other institutions. We are seeing the level of demand in our strategy increase from a variety of investors due to the fact that we have been significantly outperforming our peers. We offer a liquid monthly strategy, and we focus exclusively on European credit.